Hi, welcome to Retiring Well. Folks, we got a great show lined up for you today. We're going to be talking about those exceptions to the 10% penalty as it relates to IRAs. We're going to talk about waiting on Social Security from a tax standpoint, why that might make some sense. We're going to talk about sequence of returns. We're going to talk about 1031 exchanges and capital gains. Got a great show, so stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi, in this segment, I want to talk to you about the 10% penalty exception. Okay, well, first of all, let me tell you what the penalty is. If you're in an IRA or a qualified plan, if you take money out of those plans before age 59 and a half, guess what? Uncle Sam wants to charge you a 10% penalty. Now, why? Because they want to discourage you from doing that. They want you to save for retirement. But there are some exceptions to this penalty, okay, or this 10%. So now you still got to pay tax on the IRA if you take it out, but can you avoid the penalty? Well, here's some exceptions. Medical costs. Okay, if you have medical costs in excess of 7.5% of your adjusted gross income, now remember these are the amounts that you need to get when you're itemized, well then if you take money out of the IRA for those costs, no 10% penalty. If you have to pay for health insurance because you've been unemployed for maybe 12 weeks or more, there can be an exception for that distribution going towards health insurance. There's an exception for the penalty for disability. Now, in this particular case, you have to have a physician, determine that it's going to be long-term or permanent, but you can take money out for that cause. If you inherit an IRA, okay, now you have to be a non-spouse, but if you inherit that IRA, you're not subject to that 10% penalty if you take the distribution. Now, if you're a spouse and you put that into an IRA that's titled Inherited IRA, then you might be able to avoid that 10% penalty. There's what they call 72T distributions. It's just an IRS code, but it's basically substantially equal periodic payments. If you can take money out of your IRA and spread it out over your lifetime based on some tables, then you can avoid that penalty. Now, there's a key here. You have to take it out for a minimum of 5 years or age 59 and a half, whichever is later. Okay, there's an exception if you take it out for higher education. This can be for a spouse, children, grandchildren. It can be for books, room and board, fees, etc., all kinds of costs. Now, you have to be enrolled at least half time, but there you can avoid the 10% penalty. You can avoid the penalty for first-time home buyers. Okay, now each spouse can take $10,000, and you also can't have had purchased a home within like 2 years, but you can also use that and avoid the penalty. There's one for qualified reservists. If you've been called to active duty for more than 179 days and you take these distributions during that duty time, you can avoid the penalty. Folks, this is all spelled out in what we call IRS Publication 590B. If you think you're somebody that might be able to take advantage of that, then you're going to want to look for that. Now, in some cases, it can be a 401k when you're older than age 55, but you have to have left that employer, and you have to be careful you didn't roll it over into an IRA. So hopefully you found this valuable. If you're somebody out there that this is a concern for or want to know more about it, then certainly give us a call.
Very helpful information that Larry shared there about those 10% penalty exceptions, and it's something that I know in 2020 there were some additional ones added to that list, but those went away at the end of the year of 2020. So now we're looking at specifically with these exceptions. I know, Nick, you've come across a handful when it comes to like 401k planning, and so maybe talk through that, what you're seeing in Gaylord.
So just recently I had a client that came over to Centennial Wealth, and the majority of their funds was within their 401k. And they were under the age of 59 and a half. So the issue was, well, we don't really want to roll over our 401k to an IRA because they're under 59 and a half and they're going to have to pay that 10% penalty. But they can still keep money in their 401k and take income from that until they get to age 59 and a half and then roll the rest over at that point in time. So we went through that. We planned that all out to include Social Security at age 62 as well, and mapped it out all, and it worked well for their situation.
Yeah, so true. And a lot of times within those 401k plans, you're typically limited to what your different investment options are. And so a lot of times people are sort of anxious, I guess, when they get to that retirement to transition the money from 401k over to IRA. But it's a perfect case that Nick described there of when you should leave some money in the 401k. But another option comes with, Larry mentioned the 72T. If you're retiring prior to 59 and a half, then there's a way that you can structure equal periodic payments from your IRA and again avoid that 10% penalty. I think that's essentially everybody's goal, is to avoid those extra penalties to the IRS. And so if that's somebody like you that's in that situation where you're approaching retirement and not quite sure the ins and outs of what that looks like, we'd be more than happy to sit down with you, discuss your specific plan and maybe how you want to structure your income in retirement, as well as then look at, from a tax perspective, what's going to be the best way to handle that. So stay tuned, as we're going to be diving into waiting to take Social Security from a tax standpoint, as well as sequence of returns.
Hi, my name is Jack Clunder, and I'm a financial advisor with Centennial Wealth Advisory. My wife and I moved up here 13 years ago, and we have really enjoyed raising our 4 children in the beautiful northern Michigan country that we have. If you've been watching the show for a while, you know what we specialize in. If you are at retirement or near retirement, give us a call. Call the number on your screen. We can help go through all the different aspects of planning that are involved in retiring well. So I look forward to hearing from you.
We look forward to helping you plan to retire well.
Welcome. In this segment, I want to talk to you about one reason that you might want to wait in taking Social Security. Now, there's a lot of factors that go into determining whether you should take it early or not, but I just want to give you one today that I want to focus on, and that's income taxes. Now, what I have here is I have a married couple. They're both age 62. They've decided to take Social Security early, okay? They're going to take a combined amount of almost $33,000 out. Now, they want $72,000 of income. So they're just going to take an additional $39,000 out of the IRA to make up the difference. Now, Uncle Sam says in this scenario, now it's kind of a complicated formula they go by to determining this, but basically they take half your Social Security, all your other income, and when you hit a couple different thresholds, it'll determine how much of your Social Security becomes taxable income. Now, I'm not going to go into great detail of that right now, but just understand that this couple taking almost $33,000 in Social Security, just about half of it is going to be taxable income. So then they get a standard deduction of $24,000. Their income tax in this particular case, or their taxable income, is $30,000, almost $31,000. Income tax, $3,330. Now, if they'd waited to age 70, okay, their Social Security benefits have grown, almost double what they would have been at age 62. In this particular case, if they waited to age 70, their combined Social Security would be almost $58,000. Now, they still want the same income of $72,000 at that time. So now, though, they only have to take $14,000 out of the IRA to make up the difference. Remember, back here they had $39,000. Now it's only $14,000. In this particular case, now Uncle Sam says out of that all that Social Security, only $5,528 of it is taxable income. Now, in this particular case, I got a little higher standard deduction because now they're older than age 65. But in this scenario, taxable income is zero. Income tax is zero. Now, how much tax do you want to be paying on your IRA money? I would dare say if I can get to the place where I can take money out of my IRA and not have to pay any tax at all, then that was a great scenario. Because remember, when I was putting money into those accounts, I was getting a tax deduction. Now if I take out of those accounts and I'm not paying any tax, what could be better than that? Folks, again, there's a lot of different reasons why you might want to wait to take Social Security. This, again, was just one from an income tax standpoint, but very vitally important to understand.
During a market downturn, people tend to panic. That's a natural reaction to seeing your retirement savings decline right in front of your eyes. Take a deep breath. We can help. We recommend the following 3 steps. Number 1, schedule a risk exposure review and make adjustments if necessary. Number 2, request a retirement income analysis to serve as the starting point for your retirement strategy, making sure your money lasts as long as you do. And number 3, develop a holistic financial plan. Call or click to request a free, no obligation meeting, either in person or over the phone or video chat. We look forward to meeting you. Plan to retire well.
I want to take this opportunity to thank you for watching this show week after week. You know, every week we try to give you valuable information that you might want to know and making your retirement vision a reality. Listen, there are some pitfalls out there that you're going to want to know about. You know, I share a number of things with you each week, but there are some that if I had to take 3 or 4, it would be these. And I'm going to share them at this live event. Now, historically, we've always done this, put it together with a dinner at a restaurant. We don't feel comfortable with doing that just yet. It might be a little bit early for that, but what we are going to do is put this event together in a movie theater. Okay, there we can respect each other's social distancing. We can put on the event. I can give you some valuable education that you're going to want to know. So folks, call the number on the screen, visit the website that's also posted on the screen, and sign up for this today. Look forward to seeing you there. Hi, welcome back. Listen, in this segment, I just want to have a little bit of fun because I want to talk to you about what they call sequence of returns. Now, there's a lot of financial jargon in our industry, you know, and you'll find that anytime we're talking about any kind of financial jargon, we want to give you a thorough understanding of what we're really talking about. Well, one of those things sometimes you'll hear people talk about is what they call sequence of returns. And the conversation I would like to have around this is, do you know that it doesn't matter the order of your returns, you're going to arrive at the same amount no matter what? And so I thought it'd be fun to kind of illustrate this on Chalk Talk to kind of give you a feel for what I'm talking about. So here's a person who has $100,000, all right, and they're going to get, in 4-year period, they're going to get an 18% return the first year, a 7% return the second year, a 12% return the third year, but then all of a sudden they're going to lose 40% in 1 year. Maybe this is like a 2008 or something. So you follow me on the math. The first year they make 18%, 18,000. They now have 118,000. Second year, 7%. They're now at 126. Third year, 12%. They're now at 141,000. And by the fourth year, now all of a sudden they lose 40% in 1 year, lose 56,000. But they're at 84,000. Now, what if I was to reverse that order? So the first year, instead of the last year losing 40%, what if they lost 40% right off the bat? And then in reverse, got 12% the second year, 7% the third year, 18% the fourth year. So let's look at that. How would that come out? Well, first year, I lost 40%. I'm down to $60,000. But now I start to build it back up. I get 12%, I get to 67.2. 7%, I'm now at 71,000. Now by the fourth year, 18%, guess where I'm at? $84,000, the same place. It didn't matter. Changing the frequency of the returns had no difference. Now, why is this important? It's just important to understand that, you know, that's the way the math is always going to work out. Now, some people, in fear that they're going to get a big negative, might want to take a little bit more risk on the normal because they think if I can just get some bigger returns in the early years, that'll make up maybe for that negative year. I'm just going to tell them, I'll talk to them about sequence of returns and say, listen, the sequence of that doesn't matter. Whether you get the first year or the last year, the math is the same. So again, just thought I'd have a little bit of fun with you on that. Isn't it interesting that that's the result no matter what? So anyway, hope you found that valuable. Was a little fun. But if you want to know how maybe that affects you and your retirement and your planning, then give us a call.
Great information that Larry shared there, and I would say Social Security and tax planning are probably the two top topics that we come across when we're talking to folks just like you that are either approaching retirement or in retirement. And I know, Nick, you recently had a case where you were talking specifically about Social Security and taxes.
Yeah, so I had a couple come in to the Gaylord office the other day, and they're both 62 years old, and they wanted to start taking Social Security, both of them, right at that point in time. And we have a great software program where we can run the numbers and show them what that looks like if they were to possibly wait to take Social Security. They had a decent sized portfolio, and it was suggested that, hey, maybe it might make the most sense if you take the lower Social Security and wait on the husband's, which is higher, to maximize that if one spouse were to pass away. And they never really thought about that. They just wanted to take their Social Security and run with it. Whereas the software program allowed them to get that 10,000-foot view on what retirement looks like for them, taking Social Security and actually waiting to push it off for a few years.
Yeah, very true. I know a lot of times people come in and they're anxious. Okay, I'm at that age where I can take Social Security. I should just take it now. But that's where it comes into play of determining, hey, what other factors, especially when it comes to tax planning, and what other assets you have that you may want to consider drawing from. And that's where the other segment that Larry talked about, the sequence of returns and how important it is to look at from an income perspective. So let's take an example of saying, okay, that start with $500,000, and let's assume you're drawing 5%, so $25,000 a year. Well, what happens if all of a sudden you were taking way too much risk and your money dropped in half? That $500,000 went to $250,000. You still want the same income of $25,000. Now that's a 10% withdrawal rate, which from our perspective isn't sustainable when it comes to your retirement planning. So sequence of returns is very important, but it's even more important when it comes to your income planning. So if that's something that's top of mind for you, you're welcome to give us a call, and stay tuned as we're going to be diving into 1031 exchanges and capital gains next.
Will your money last as long as you do? Check out our free instant download on sen-wealth.com on the key financial challenges that can make or break your income plan in retirement. To receive this instant download, simply visit sen-wealth.com, scroll down, and click Download Now to receive your copy of Will Your Money Last as Long as You Do? Simply visit sen-wealth.com.
Professional golfers have a game plan. Knowing where to attack the golf course is vital, and avoiding the hazards is key. As you can see, we aren't professional golfers. But at Northern Michigan's Centennial Wealth Advisory, we are professional financial advisors. Give Centennial Wealth Advisory a call or visit us at sen-wealth.com and let us help you plan to retire well.
In this segment, I want to talk about 1031 exchanges. Now, folks, 1031, all that's referring to is the IRS tax code number that talks about these. Now, in a 1031 exchange, what you're trying to do is defer the gain on the sale of, let's say, property. Okay, so let's say you bought this property for $100,000 originally. Now you want to sell it for $200,000. Okay, so you have $100,000 that you want to defer. In a like kind of exchange, you have to buy, for it to be effective, you have to buy of equal or greater value. So for me to defer that $100,000 gain, what I want to do is buy another property for at least $200,000 or more. Now, by doing so, that $100,000 deferred gain gets transferred over to the new property. So let's just say, for all practical purposes, I exchange it for some property worth $220,000. Now my basis in that new property is $120,000 with a $100,000 gain starting with day one that'll have to be paid down the road when I sell that property. Now, I have to be careful because I can't incur any new debt when I do one of these kind of exchanges. That'll create what's called boot and then can make some of it taxable, so you got to be careful of that. I have to use what's called a qualified intermediary. What the qualified intermediary is going to do is going to hold the proceeds from the first sale, and then they're going to hold them towards the purchase of the next sale, where you can't receive any of the proceeds. Okay, it's going to be very important. And there's actually what they call a qualified intermediary agreement that has to be part of this arrangement as well. So they effectively they hold the proceeds, and then they try to make the sale happen properly according to the rules. Now, the property must be like kind. You know, it has to be, if you're doing real estate, it's going to be real estate you're going for. You have to be able to identify that property that you want to exchange for. You have to identify it within 45 days of the close of the property you just sold. So you sell the property for $200,000. Now you've got 45 days to get out there and try to find what property that you're gonna purchase. Now there's different ways you can identify these properties. You can identify 3 and then maybe just close on the 1. There's some other ways you can identify a number more properties, but you have to meet certain rules. Now, all that being said, you identify the property within the 45 days. Now you got to close on that property within 180 days. So folks, as this is something that you'd like to maybe look at or do, it can be very valuable, but it comes with some very tight restrictions or rules associated with it that you're going to want to know about. If there's anything like that we can help you with, then give us a call. I want to take this opportunity to thank you for watching this show week after week. You know, every week we try to give you valuable information that you might want to know on making your retirement vision a reality. Listen, there are some pitfalls out there that you're going to want to know about. You know, I share a number of things with you each week, but there are some that if I had to take 3 or 4, it would be these. And I'm going to share them at this live event. Now, historically, we've always done this, put it together with a dinner at a restaurant. We don't feel comfortable with doing that just yet. It might be a little bit early for that, but what we are going to do is put this event together in a movie theater. Okay, there we can respect each other's social distancing. We can put on the event. I can give you some valuable education that you're going to want to know. So folks, call the number on the screen, visit the website that's also posted on the screen, and sign up for this today. Look forward to seeing you there. In this segment, I want to talk about capital gains, most particularly how they're taxed. First of all, a short-term gain is one in which that you buy a security and you sell the security within a year. If you do that, it's considered short-term, and it's subject to what you call ordinary income tax rates, basically whatever bracket you're in. Okay? Now, if you buy a security and sell it in longer than 1 year, okay, now it's considered a long-term gain, and it gets taxed depending on what your income is. Okay, if you find that gain is entirely in the lower bracket, which would be the 12% bracket, then it gets zero taxed. If it falls outside that bracket, then depending on your income, it can be 15 or 20%. But that's all. That's the maximum they can charge you on those. So great benefit if you can try to realize those gains in a lower bracket. Now, a lot of times at the end of the year, you'll get these statements and it'll show you these unrealized gains on your portfolio statement. Okay? Now, all that is that these are securities that you've purchased, you've held, but they haven't been sold. And understand, you're not going to pay tax on them till you sell them. So tax harvesting can be very valuable where you're going in maybe at the end of the year and you're trying to sell off some of the positions with gains and then maybe offset it with some that have losses. So recognizing where you're at in that in tax planning is going to be beneficial. Now, if you inherit an account that's got a lot of unrealized gains and it's a non-qualified account, which just simply means it's a non-retirement account, you enjoy what's called stepped up basis, meaning you can pass those on to your heirs and they get to step up the basis to the fair market value upon your death. So there's cases where you can have these unrealized gains and no gains are ever going to be paid on. Again, you can offset losses with gains. So, you know, if you can look at that and try to tax harvest that at an appropriate rate, going to be highly valuable. Now, in IRAs, you don't have to worry about it because, you know, there is no capital gains. Basically, every dollar you take out of an IRA is going to be taxed. Now, on rental property, you got to be real careful because all that depreciation you took over the years, that has to be recaptured, and the rate is 25%. Collectibles and coins, 28%. And then folks know this, that there's a limit on on the net losses you can take in a year. For a married couple, that's $3,000, but you can carry them forward indefinitely. For single people, that's $1,500. But what you don't use, you can carry forward indefinitely. So folks, if you're somebody that maybe has some of these kind of positions, you don't really know how to tax harvest them yourself, want maybe a little bit of tax planning to help you with that, then give us a call. We'd be glad to help you.
Well, Larry was talking a lot about taxes, and there's the two things that we're all sure of: death and taxes. So let's talk about taxes. And so one of those, when it comes to the 1031 exchanges, and we're looking at capital gains and whether to potentially realize capital gains or not, one of the things that comes to my mind is where we're all talking about right now of the assumption that tax rates are going to be going up in the future. And so it's one of those situations where we're looking at, should we potentially be realizing some of the gains maybe on those different investments, whether that's on real estate, whether that's on different after-tax or non-qualified investments that you hold or businesses that you may be looking to sell, and whether you should realize that or kick the can further down the road. And that's where, again, it comes back to tax planning as a vital piece of your overall retirement plan.
Yeah, and we have an awesome team that just does that. That's all they do is tax planning, whether it's Roth conversions or what John was talking about. Our team is here to help, and that's what we're here to do for you. So
yeah, and one of those other areas is sort of tax loss harvesting that we look at when it comes to capital gains. So you may have, say, different gains that you've accumulated over the years, but you can potentially realize losses on maybe some of the other investments that you hold. And so it's a matter of year by year looking at what your investments have and what the unrealized gains may be, and trying to balance those out to try and ultimately keep as much money in your family's pocket versus paying additional taxes that you may not have to. So if you find yourself in a situation where you're looking at, you know, whether that's different investments, different real estate businesses that you hold, and what those maybe gains that you either have realized or haven't realized yet, then it's something we'd love the opportunity to sit down and talk with you, better understand again what your goals and objectives are for your retirement planning, and hopefully we can help provide you a good plan to retire well. Thanks again for tuning in to Retiring Well.